We certainly will keep this committee updated. However, much of the investigation of what happened at this bank would be done by the FDIC, and so that's an appropriate source of information.
And we will make sure we ask them that same question. But I know that you'll be involved. I mean, this obviously is something that dramatically impacts the economy and would be something significantly of interest, I would think, to the Treasury Department. And I'm hopeful you'll stick to that commitment. In a previous Finance Committee hearing, you gave your, quote, absolute word to keep us updated on Treasury's findings about the private taxpayer data that was improperly shared from the IRS to ProPublica. It's been almost 2 years since that breach of taxpayer data was made public. Administration still hasn't provided a meaningful response. And you can answer that, but let me move on here. I want to ask a question about the actions taken by the administration to shore up Silicon Valley Bank and others. The Treasury issued a joint statement that stated, and I quote, "No losses will be borne by the taxpayer." Do you stand by that statement?
Yes.
And I just want to stress this is something that's deeply important to taxpayers, and I think it's something that I and I expect a lot of my colleagues, hopefully on both sides of the aisle, will be strictly holding this administration to account on. You, in the IRA, got an additional $80 billion, 6 times the annual budget of the IRS, through the, I should say, not directly Treasury, but the IRS, and 87,000 new employees. Now, the request in this year's budget, because that's what we're talking about here today, is for an additional 15% increase, somewhere on the order of $29 or $30 billion in additional. We still don't have the plan for the $80 billion in IRS funding, and there was supposed to be a plan made public several weeks ago. So could you speak to when we might see a plan, since there's a request now for additional funding above and beyond what was a massive, historic amount of funding in the IRA?
So the plan is almost complete, and you should have it in the near future.
And what does that mean, near future?
In a matter of weeks.
Okay. All right. I hope that you can follow through on that. And let me just ask, with respect to the use of that $80 billion, some of it I know was supposed to be funded toward taxpayer services, which I hope is the case, because the IRS has had a deplorable record on getting back to taxpayers, 13% phone call return rate. How much of that $80 billion is going to be directed to enforcement, and does the Treasury expect that any of that revenue is going to come from increased audits of middle-class taxpayers?
The President and I have committed that there will be no increase in audit rates on individuals or small businesses under $400,000, and I stand by that pledge, and I've issued a directive to IRS to that effect. And most of the hiring, the large numbers that are seen, are replacement of people who are retiring. But there will be additional hiring, both of customer service representatives. 5,000 more were hired this season, and the response rate has gone from the 13% you mentioned to around 85% this tax season, and we want to keep it at that level and add other things that will make filing and interacting with the IRS more convenient for both individuals and for businesses. But an important goal is greater enforcement, hiring of skilled tax lawyers and auditors and accountants to deal with high income and high net worth individuals, complex partnerships, and corporations where we think most of the tax gap is centered. And so, although $80 billion over 10 years, it sounds like a huge investment. It's one with an enormous payoff, that it substantially lowers the budget deficit because we have a huge tax gap that needs to be addressed.
The time, my friends, expired. We're going to push very hard to get every finance member a chance to ask their questions before we go. Next will be Senator Lankford, Senator Cortez Masto. We've got the secretary till 1. Senator Lankford.
Thank you. Madam Secretary, thanks for being here. There's a lot of things that I wanted to be able to talk about on this. We've got some tax proposals on the table. I have a bipartisan charitable act dealing with tax policy that we're not going to have time to be able to talk through. I'd like to be able to talk about full expensing. Senator Toomey used to be able to champion this, but it's a big issue for our manufacturers in my state and all around the country. Love to get a chance to talk about that. I'd love to talk about marriage penalties in the tax code because, quite frankly, they're still there. It's one of the things we've got to be able to work on, energy independence. I did notice a whole new set of new taxes on energy companies in the United States that I think would hurt our energy independence. And there's still no definition for the $600 if you do Venmo payments to somebody up to $600. Now the IRS is going to track you. I've noticed that you've delayed that, and the IRS has delayed that. But there's a lot of questions with that, and new creative definitions of what it means to be made in America. We now have new treaties that are popping up that are not really treaties, not really free trade agreements, but are being declared free trade agreements to allow from the Inflation Reduction Act actions from Japan and Germany to now be defined as made in America. I find that very creative. Love to talk about all that. Don't have time. I'd need to be able to drill in on a couple of things. Let me start with some of the banking issues we're dealing with on it. Will the deposits in every community bank in Oklahoma, regardless of their size, be fully insured now? Are they fully recovered? Every bank, every community bank in Oklahoma, regardless of the size of the deposit, will they get the same treatment that SVBP just got or Signature Bank just got?
A bank only gets that treatment if a majority of the FDIC board, a supermajority of the Fed board, and I, in consultation with the president, determine that the failure to protect uninsured depositors would create systemic risk and significant economic and financial consequences.
So what is your plan?
And we made that determination.
Right. So what is your plan to keep large depositors from moving their funds out of community banks into the big banks? We have seen the mergers of banks over the past decade. I'm concerned you're about to accelerate that by encouraging anyone who has a large deposit in a community bank to say, we're not going to make you whole, but if you go to one of our preferred banks, we will make you whole at that point.
Look, I mean, that's certainly not something that we're encouraging.
That is happening right now.
That is happening because depositors are concerned about the bank failures that have happened and whether or not other banks could also
No,
fail.
it's happening
And
because you're fully insured no matter what the amount is if you're in a big bank. You're not fully insured if you're in a community bank.
Well, you're not fully insured. And
You were at Signature, and it just barely met that threshold. You were at Signature.
Well, we felt that there was a serious risk of contagion that could have brought down and triggered runs on many banks. And that's something, given that our judgment is that the banking system overall is safe and sound, depositors should have confidence in the system, and we took these actions.
So there's a special assessment that's been done
contagion.
on community banks in my state and all banks across the country. Was there any discussion that that special assessment would only apply to the larger banks, or was it always assumed the special assessment would cover every bank, including rural banks in my state?
I think, I'm not certain what the rules are around that. That's for the FDIC to determine.
It has been reported publicly that SVB had a large number of Chinese investors that are there, including some that were companies directly connected to the Chinese Communist Party. Will those individuals, companies, entities, and investors that are Chinese investors be made whole based on assessments in my banks in Oklahoma? So what I'm asking is, will my banks in Oklahoma pay a special assessment to be able to make Chinese investors whole from Silicon Valley Bank?
uninsured investors will be made whole in that bank, and I suppose that could include foreign depositors, but I don't believe there's any legal basis to discriminate among uninsured.
I get it, but I'm just saying my community banks are going to pay this additional fee. It is always fascinating to me as well, the conversation that taxpayers are being made whole in this, that taxpayers are not going to have any kind of consequence on this. I'm sure my bankers are going to be very excited to know they no longer pay taxes, and their banks no longer pay taxes. Credit unions don't pay taxes, banks do, and so they're definitely taxpayers as well, and all banks make their revenue off of rates and fees and such to their account holders, which means every Oklahoman will pay higher fees in their community bank.
We're just going to have to move on.
If we have a collapse of the banking system and its economic consequences, that will have very severe effects on banks in Oklahoma that will also be threatened.
I'm just worried about the long-term
We are going to have to
consequences
move
on our banks
on,
as
or
well.
we're not going to get all senators in. Senator Cortez Masto.
Thank you, Mr. Chairman. Secretary Yellen, it's always good to see you. Thank you.
Thank you,
Before we get to the banking and the budget, let me ask you something that's important in my state, and I think across the country, quite honestly. These are the low-income solar tax credits. It is a question that I asked Commissioner Werfel regarding Section 13103 of the Inflation Reduction Act, which provides a bonus investment tax credit for certain renewable energy investments that were made in low-income communities. The February guidance that Treasury puts out provides the potential applications will only be considered for this tax credit during limited application windows. And this is my concern, will limit solar deployment and the ability to drive clean energy investment in these communities, because the investments with tax credits happens when you have certainty up front that the credit can be used. It's especially important because the law requires that the bonus credit that we put in the Inflation Reduction Act be tied directly towards reductions in energy bills for consumers. So in light of these challenges and the headwinds facing the solar industry, and I'm going to talk a little bit about that as well, can you share anything regarding the process for revising the guidance in this very near future to meet the intent of Congress, not only here with the solar tax credit, to ensure that people can access it in a timely way before it goes away, but the guidance in general that you've talked about, because everybody's waiting for guidance to be implementing the Inflation Reduction Act proposals we put in there, and concern about they're going to come too late before we can even utilize the opportunities.
All I can say is that we are working 24/7 on the guidance and regulations that need to be written in order to implement the various tax credits that are in the IRA. We have no higher priority at Treasury, and we are really working tirelessly to get this done. My understanding is that we've committed to open the first phase of applications for this credit in the third quarter of this year, and we will provide detailed guidance ahead of accepting applications.
So let me put a proposal out there, and this is for some of my colleagues as well, because I think in general the Inflation Reduction Act and the work that we have been doing to lead us into this clean energy future requires a bridge to get us there. Requires a bridge to get us there. And let me just say this. I support the manufacturing here in this country, and we need to build it and grow it. But when it comes to solar, we're not there yet. I support the manufacturing that is happening in Ohio and here across this country. But the manufacturing for the supplies that we need to grow out solar in this country has a capacity of 5.6 gigawatts. Now, let me just say in 2022, we were able to actually install, the demand was for 20.2 gigawatts. So we are at a deficit there. And if we don't get these supplies, if we don't have what we need to address bringing these supplies here from somewhere and deal with the tariffs that are out there that are limiting our access to these supplies, we are going to be limited to the amount that we can grow our clean energy in this country through solar. So that's what I would love the administration to keep in mind, my colleagues as well, that yes, we want to make sure that we're getting our supplies from countries that we support, that are friends, that are our partners, absolutely. But until we grow our domestic manufacturing here, we are not going to meet the demand for solar in this country that we need right now.
We're going to try.
Well, there is substantial incentives in this legislation to bring manufacturing of solar panels to the United States, and we're certainly picking up great interest among investors in moving manufacturing here. We're trying to get out the regulations as rapidly as we possibly can to make sure that we provide the certainty that's needed for those investors. But there are big incentives in this package to do just that, and we're excited to see what's happening already.
And I don't mean to cut you off. I only have so much time. Let me just talk about the budget real quick, what I see here. Is it true that the federal deficit has been reduced by over $1.7 trillion just in the last 2 years?
Yes, that is true.
And it's also true what you said earlier, that this budget proposed by this administration looks at also an additional deficit reduction of $3 trillion years over 10 years.
That is correct.
So this administration is concerned about reducing the deficit, correct?
Yes.
And the debt limit that we were talking about, everybody's talking about, that debt limit, let's be fair, let's talk in a bipartisan way, that debt was incurred by both previous Republican and Democratic administrations, correct?
Yes, when we're talking about paying bills that for spending and that Congress has authorized.
I appreciate that. Thank you. I know I'm over my time. I will submit the rest of my questions for the record. Thank you, Secretary.
I thank my colleague, and I will just say during the 10-year odyssey of developing those clean energy tax credits, it was always our intent to have the bonus solar tax credit for low-income communities. So we'll continue to work with my colleague. Senator Warren.
Thank you, Mr. Chairman. So on Friday, the United States faced the second biggest bank failure in our entire history. And as panic spread among small businesses and nonprofits that had money deposited with Silicon Valley Bank, Treasury and other financial regulators announced they would take emergency measures to stabilize the system. I'm grateful for the administration's steady hand, but we shouldn't have had to be here in the first place. These bank failures were the direct result of policymakers' decisions over the last 5 years, beginning with a 2018 law signed by President Trump with the support of both parties to weaken the regulations that had been put in place after the 2008 financial crisis to ensure that big banks never again crashed our economy. On Monday, President Biden called on Congress and regulators to, quote, strengthen the rules for banks to make it less likely that this kind of bank failure will happen again, end quote. Secretary Yellen, thank you for being here today. Do you agree with the President that we need to strengthen our banking rules?
Well, I think we certainly need to analyze carefully what happened that triggered these bank failures and re-examine our rules and supervision and make sure that they're appropriate to address the risks that banks face.
Okay, so we want to make sure we've got the right rules in place. And pretty obvious we need some stronger rules here, so I want to talk about those rules, the stress test. Stress tests are critical tools in the regulatory toolbox that are designed to expose banks' vulnerabilities if bad things happen and force the banks to shore up any weak points before it's too late. Now, Secretary Yellen, when you were implementing the Dodd-Frank regulations as Fed chair 6 years ago, back in 2017, you said, quote, our stress testing regime is forcing banks to greatly improve their risk management and capital planning, end quote. But you warned that because, quote, we can never be confident that there won't be another financial crisis, it is important that we maintain the improvements that have been put in place that mitigate the risk and the potential damage, end quote. So I want to talk about those stress tests that you talked about, how important they were 6 years ago. Secretary Yellen, can regular rigorous, well-designed stress tests help bank regulators spot problems lurking in banks' balance sheets and business models?
Yes, I continue to endorse the comments
Good.
you quoted. I think this has been one of the most important and consequential improvements in supervision since the financial
Okay,
crisis.
so,
But
two thumbs up for stress tests. Let me just ask, when regulators spot these problems early on, can those regulators then require the banks to clean up the problems long before they trigger a run on the bank?
Yes, and in that sense, they're useful, but I would like to make one point.
Sure.
Which is that the supervisory stress tests focus on capital
Yes.
and not on liquidity. And in these bank failures, liquidity played an important role.
So let's ask the question then all the way around. If stress tests are done right, if we have robust stress tests, the way you described 6 years ago when you were still running the Fed, do they just test one thing that might go wrong, or do they test for lots of different problems if they're done right?
If they're done right, they test for many possible problems, but they do not focus on liquidity.
Okay, but they test
focus
for
on
many
capital.
kinds of things that go wrong. Is that right?
Yes,
Potentially.
there are different scenarios every year, and
So let me ask you then a related question. Is one of the problems that stress tests can expose is that you have managers who are not very good at managing risk, or management that is otherwise doing a bad job that could put a bank in jeopardy?
well, that's the purpose of supervision. And supervision, stress tests are one tool. Supervision is another tool that's critical.
Okay, so
Focuses
very
on other
important. We've
things.
got stress tests, we've got supervision, we've got a lot of pieces here to make this work. In 2018, though, Trump's bank deregulation law and the door it opened for Fed Chair Powell to further hack away at the rules created an exception to annual Fed-administered stress tests, letting banks from $50 billion to $250 billion effectively off the hook. And that meant that a bank like SVB, which had $209 billion in assets when it failed, would be exempt from annual stress testing. So the question I have here is, if the law had not, let's not just do stress tests. It's stress test, it's the whole package. Enhanced liquidity requirements that ensure that banks have enough cash on hand to meet their obligations, particularly in times of stress, capital requirements that better position banks to absorb losses, regular resolution plans to help guide regulators safely through winding down failed banks. All of these were weakened in 2018, and when SVB failed, this is a part, in my view, of the Fed's actions that led to weaker regulation. You know, over the last few days, we've heard a lot of Republicans say that this collapse wasn't their fault. It was the banking regulators who were asleep at the wheel. And believe me, I have questions for a lot of the banking regulators. But Congress handed Chair Powell the flamethrower that he aimed at the banking rules. In fact, he said so himself. I'll quote and then I'll quit. When he announced that he was weakening regulations for the banks like SBV, Chair Powell said, and I quote, "In the rules before us, we are applying the discretion granted to us by the Economic Growth, Regulatory Relief, and Consumer Protection Act." Translation: Congress opened the door to weaker regulations, and I'm waltzing right through it. That's true. Congress needs to close that door. I'm sorry, Mr. Chair.
My colleague has great experience in this, and I apologize for having to cut people off. Senator Johnson's next.
Did you call on me? Okay, thank you, Mr. Chairman. Welcome, Secretary Yellen. I just want to start, do you know how much a dollar that you held at the start of the Biden administration in January 2021 is worth today?
Well, we've had inflation, and it's declined in its purchasing power.
It's worth 87 cents. In your testimony, you said that inflation is the #1 economic problem. Do you know what the inflation rate was at the start of the Biden administration in January 2021?
It was substantially lower.
It was 1.4%. You said that inflation has many causes. I agree with that. By the way, I would say that the number one economic problem is our debt and deficit. And I would say that the top three causes of inflation are massive deficit spending, the war on fossil fuels, which have driven energy, gasoline prices to record levels, obviously supply chain dislocation, that was caused by our miserably failed and incredibly stupid response to COVID, the pandemic. But would you agree those are the top three causes of inflation? Deficit spending, high energy costs, and supply dislocations?
I don't believe that deficit spending is one of the main causes of inflation.
I mean, inflation is too many dollars chasing too few goods.
Well,
so when you're printing all this stuff, so do you know in the first 3 fiscal years of the Biden administration, you know how much the total deficit spending is going to be?
We had an economic collapse that was caused by
right,
the
and
pandemic.
we were certainly coming out of that because there's all this pent-up demand and a sloshing around of trillions of dollars. So I'll answer that question for you too. The first 3 fiscal years of this administration, the total deficits would be about $5.7 trillion. So now you're here testifying about the president's budget. How much are the total deficits over that 10-year period according to the president's budget? You don't know that off the top of your head? Yeah, I'm running out. It's $17 trillion, okay?
Yeah, that's
You're going to drive the debt from somewhere around $32 trillion up to about $50 trillion, correct?
yes, but what I believe is the single most important metric for judging the fiscal stance of the country is real net interest as a share of GDP.
Okay.
We have
so are you
a
concerned
large
when you're
GDP.
taking the debt from $32 to $50 trillion? Are you concerned who's going to buy that debt, and also at what rate they'll expect to be compensated for buying riskier and riskier debt? Are you concerned about that?
Well, if the real net interest cost of the debt remains low relative to GDP, and we're on a sustainable fiscal
Well, we're not on a
Well,
sustainable path.
I would
Senator
disagree
Cassidy was talking about the president's demagoguery on Social Security, unwillingness to meet to try and save Social Security. If we do nothing, and the Social Security Trust Fund runs out 2023 to 2025, about the end of the budget period, are you concerned about, are we going to have the financial wherewithal to plus up benefits to honor those promises? I mean, you think we're going to, with $50 trillion in debt, you know, a debt exceeding our GDP, aren't you concerned about our inability to honor those promises?
The interest cost on the debt as a share of our economy remains quite low throughout the 10-year horizon of the president's budget. It remains around 1%.
Secretary, and you're also the one who said that
very manageable.
You also said that inflation was transitory, and it certainly isn't. And I think Chairman Powell certainly now agrees the fact that, no, we've got something going on here that's going to take a very long while, unfortunately, to wring out of our system. Not only you, but OMB Director Young and members of the other side keep talking about that you're cutting deficits. The deficit in 2021 obviously was high because of the pandemic, but in 2022 is about 1.4 trillion. 2023, we think it's going to be about 1.6 trillion. 2024, you're projecting 1.85 trillion, and again, growing debt by another 7. It never drops below 1.5 trillion dollars. How can you claim that you're cutting deficits?
Well, it always is a comparison with the baseline of what would happen if our policies were not
really
enacted, and the increase in deficits would be larger. There's net deficit reduction over 10 years.
Saying you're cutting the deficit is just misleading the American public. Let me ask you one final question, because we always hear on the other side, same thing from OMB Director Young yesterday, that we want to make the rich pay their fair share. So, I mean, the fact is, and this is the latest figures we have from the Treasury, 2020, the top 1% made about 22% of income, but they paid 42.3% of the income tax. Now, I'm not going to ask you the metric. At what point, I mean, how much of the total income tax should the top 1% pay before you'll consider and before President Biden will consider they're finally paying their fair share? I mean, they're paying double the income tax that they're getting in income. It's obviously a highly progressive rate. By the way, the bottom, they're paying about
colleague's over his time, and I want the witness to answer his question.
Well, I believe that billionaires should pay rates that are not lower than what a teacher or firefighter pays.
Okay, the top 1% averages effective
The
rates.
time of the gentleman's expired. Senator Tillis is
My
next.
colleague got 7 minutes. The top 1% pay an
The time of the gentleman's
26%.
expired.
The bottom 50% pay 3.1. We have a highly progressive tax system.
Senator Tillis, you're next.
Thank you, Mr. Chair. Madam Secretary, just real quick on this question. The president's budget, I think, assumes 4.3% inflation through calendar year 2023. Number one, can you confirm that or give me an accurate number if I'm wrong? And then just describe for me, how do we do that, particularly in light of what's happened with SVB and what I think we will continue to see monetary policy that's going to increase incrementally until we get inflation under control. That creates other stressors for the banking community. But is it 4.3%? And do you agree with that assumption?
Did you say inflation?
Yeah, inflation. For calendar year 2023.
We assumed that inflation would run at 3%.
At 3%. And we're in the tail end of March. So you still believe, given the inflation estimates that we got, that that's still a valid assumption?
It is coming down on a 12-month basis, and
Yeah, okay. If we could just get to the committee, the analysis that went into that, I think it'd be helpful. I want to go back to Senator Warren's question or comments very quickly. Back in 2017, I think you were quoted before the Joint Economic Committee with respect to Senate Bill 2155 that the Fed would still be able to impose enhanced prudential standards on firms if necessary, and that the bill is a move in the right direction that would be good enabling for the Fed to appropriately tailor its supervision. Do you still stand by that statement?
I think that I said that I thought tailoring is appropriate, and I still believe that. And
Okay.
I think the Fed
Thank you.
continues to have.
I guess the question that I have, because I don't agree with Senator Warren's the premise of her questions. It seems to me, unless we and I should say that in that same time frame, Mr. Torello was responsible for implementing a bill that he publicly criticized, Senate Bill 2155. He did not like the bill. He's over there helping implement it. And yesterday,
When wasn't it passed in 2018? He left.
No, I'm sorry. When you were implementing Dodd-Frank, I'm sorry.
Sorry.
So when you were implementing Dodd-Frank, Torello was in play. Then we passed Senate Bill 2155. He was highly critical of it. However, he said as late as yesterday, he doesn't believe that Senate Bill 2155 had anything to do with what occurred at Silicon Valley Bank, and that his suspicion was that it was supervisory, maybe supervisors not being aggressive and potentially using some of the discretionary regulatory regimens that were allowed in Senate Bill 2155 if you happen to have a specific bank that had activities where you should increase the level of supervision. So it seems to me that here we're using 2155 as a red herring for something that I believe fundamentally is going to be a supervisory or regulatory lapse. I want to ask you a question about OECD in my time remaining, and I do want to get close to 5 minutes. The baseline agreement doesn't have what I consider to be the most basic standards for dispute resolution, but it looks as if we still want to move forward with congressional action absent that. I also have some concerns with the exemptions that are in the agreement, particularly with respect to China. And I'm grossly summarizing my context to give you a chance to respond. But let me tell you, even beyond the exceptions, that benefits China and state-owned enterprises, this committee nor the Committee on Taxation has received the data and analysis that you all used as a basis for negotiating the deal. Can I just simply get a commitment that the Joint Committee on Taxation and that this committee will get that data and analysis as a part of our future consideration for the provision that has to come before Congress?
I'm sorry, I'm not sure if you're talking about Pillar 2 or Pillar 1.
I think it's all of the above, to the extent that they're both in the agreement.
Well, I think the analysis on Pillar 2 has been done. Correct me if I'm wrong, but I believe the Joint Committee on Taxation has looked at that, and we've provided estimates as well that use standard methods and can discuss that with you. Pillar 1.
We'll submit a question for the record. My time has expired. We'll submit a question for the record to fully describe exactly what we're looking for. And to the extent that it's possessed by some members, then I'll stipulate that I was wrong. But I'm going in with a little bit of a skeptical position. Thank you.
I thank my colleague for his courtesy, and we'll have the staff, the finance staff, share what we have on Pillar 1 and Pillar 2 with my colleague. Senator Blackburn is next.
Thank you, Mr. Chairman. Madam Secretary, thank you for being with us today. I want to return to the SVB issue and ask you, I haven't heard you say today, when were you first notified that there were problems with SVB, and when did you alert members of Congress? What was that time lag?
I believe that I first found out about the troubles at Silicon Valley Bank. I guess it was last Thursday.
Last Thursday. And then your notification of Congress came when?
The bank was put in.
Why don't you just put that in writing for me so I don't waste my time? I know Senator Langford asked you about the Deposit Insurance Fund and how that would affect our local banks. And there's a lot of concern over this. And I know you were uncertain about that. If you would run the numbers on that and let us know a ballpark of what you think this would cost if you end up insuring everybody's deposit. And then I have to ask you, being from Tennessee, you know, we have a long and storied history of opposing nationalizing the banking system. Do you see this as a step to nationalize the banking system?
Absolutely not. I see this as a step toward stemming contagion that could come from the failure of these banks that would place community banks across the country at great risk of runs as well that we want to.
Thank you, ma'am. Let me move to the Inflation Reduction Act and that implementation. I hear a lot about this from local mayors and our state agencies. There is a lot of money that can be doled out. Treasury and other agencies are going to be required to issue guidance. That hasn't come, and so there's a lot of confusion there. And I was looking at the structure, and I want to make certain that I'm viewing this right. You have the Deputy Secretary, the Office of IRA Implementation within Treasury, the Office of IRA Implementation in the IRS, and Danny Werfel, who is the new, recently confirmed IRS Commissioner. So with all of these bodies involved, who is actually in charge? Who's the final decision maker on the guidance and the timeline for releasing that guidance?
Well, our Office of Tax Policy drafts regulations, and we go through a regular rulemaking.
Then do you sign off on it? Are you the final say?
I do sign off on it. We confer with many people in the process of drafting that, and it will go through full comment and review before final.
Let me ask you something else, because the buck stops with you. You have really praised the IRA. I want to ask you one more thing about that. because your statements contradict themselves somewhat. You talk about the IRA as a way to really bring prosperity, to lower inflation, to lower the debt. So do you really believe that we can spend our way to lower inflation, to debt reduction, and to economic prosperity with
Well,
the
I
amount of debt?
I believe that this law promotes clean energy and R&D and investment in the United States.
That's not my question.
that
Do
will-
you believe we can spend our way to lower inflation? And I'm going to move on, obviously.
I've never said
we
any
don't there.
such,
Oh, well, okay.
I've never said that I think that
All
that's
right.
a
Thank
way
you,
to
ma'am.
lower inflation.
You have mentioned the IRS being able to answer more phone calls and respond more quickly because of the IRA funding. And I was looking at the IRS data, and it shows that the IRS actually answered 2.6 million fewer calls this March during the tax filing season. So, and I know Senator Thune asked you about this. If we could get some clarity from you and from your testimony about this, and what is the rate? How often are these calls answered and missed? What percentage of people at the IRS are still working remotely, and what is your timeline for bringing them all back?
What I can tell you is that the response rate to customer calls has been between 80 and 90% every week during this tax filing season, and that's a massive improvement. The IRS hired 5,000 new people to put into customer service, and that relied on funds from the IRA.
My time has expired, but the 8 Corners data call that the IRS gave in early March, the IRS says they've actually answered 2.6 million fewer calls this tax filing season.
There may have been fewer calls, but the rate of response was very much higher.
Thank you.
Hugely
Thank you,
higher.
Madam Secretary.
We do need to move on. Senator Menendez.
The Federal Reserve's emergency lending facility is predicated upon the notion that Treasury and agency securities have no credit risk. That facility will be extending loans of up to a year using these securities as collateral. But one potential problem, is that unless Congress raises the debt ceiling in the next few months, U.S. Treasury and agency securities will face the prospect of default. Now, while I certainly won't vote to default on the debt, I think some of my colleagues may not feel the same way. In light of the events in the financial system over the past week, how damaging would a debt default be to our banking sector, particularly to regional banks?
It would be completely devastating, and I don't think that Congress should for a second contemplate the possibility of not raising the debt ceiling to pay our bills. This is the cornerstone of what makes our financial markets the soundest and best in the world, and people trust that the government stands ready to pay its bills. It would be a
And
calamity.
obviously, if we're using Treasury securities to back up the loans that we're making, if those Treasury securities default, then we have a cascading effect.
It's beyond contemplation.
Is it possible, I should say, isn't it possible that if Congress fails to raise the debt ceiling well before any default, that we could run the risk of seeing more runs on regional banks?
Yes, we have seen that concern about whether Congress would meet this responsibility has provoked concern in financial markets. That was evident, for example, in 2011, when there was a downgrading of the U.S. credit rating because of doubts as to whether or not Congress would act appropriately.
Well, the fact is that a debt ceiling fight has always been dangerous. It's dangerous for our financial system.
Agreed.
It's dangerous for our businesses.
Yes.
It's dangerous for working families. And it's dangerous to put at risk
the U.S. dollar as the reserve of choice in the world, which others are seeking to replace us in, which has enormous benefits to us. Wouldn't you say that having our dollar as the reserve choice in the world?
Yes, I completely agree. It's because, in part because our financial system is so deep and treasuries are regarded as so safe and liquid.
Now, in 2018, Congress passed a bill which was signed into law by President Trump that relaxed regulation for institutions like Silicon Valley Bank. That law, which I opposed, exempted those banks from enhanced prudential standards, stress tests, raising the threshold at which a bank would be considered systemically important. So even as the law kept Silicon Valley Bank off the list of systemically important institutions, regulators, on a bipartisan basis, rightly cited systemic risk to justify their actions over the weekend. So, Secretary Yellen, isn't it true that the situation at Silicon Valley Bank posed systemic risks?
Well, look, I think it's important for regulators, the banking supervisors, to examine what happened at this bank. But clearly, the bank had a very high proportion of uninsured deposits, which made it vulnerable to runs, and it experienced a devastating run.
But, Madam Secretary, the regulators said that the reason they were intervening because there was systemic risk, then it must have been systemic risk, right?
Well, in the sense that the chances of contagion that other banks might be regarded as unsound and suffer runs seemed extremely high, and the consequences would be very serious.
Seems to me that institutions, while we still have a lot to learn, like Silicon Valley Bank, have the potential to be systemically important, and our laws and regulations should treat them as such. Let me close on the following. In the President's budget proposal, there is yet a glaring absence of a issue critical to families in my state and in other states in the country. The budget continues to allow C corporations to fully deduct state and local taxes as under current law. Isn't that the case?
I'm not sure. I think so, but
Yeah. Well, for the purposes of our discussion, let me just assure you that the budget allows C corporations to fully deduct state and local taxes under current law.
Okay.
But it does not propose the same tax benefit for middle-class families. Is that fair to say?
the issue of state and local taxes is one we think that Congress should address.
Well, I'll close by saying if C corporations can deduct state and local taxes, middle-class families should be able to deduct state and local taxes. Thank you, Mr. Chairman.
Thank you. Senator Scott.
Thank you, Mr. Chairman, and Secretary Yellen, thank you for being here this morning. Thank you also for the conversation that we had on Monday. We may not always see eye to eye on a number of the issues, but your availability was helpful in understanding and appreciating the actions of the administration. So thank you for that part.
Thank you, Senator.
I'm sure you've seen and maybe even had a big hand in proposing some of the president's budget requests. I can honestly spend hours talking about the president's budget and how much I dislike it. I think it's bad for the economy. I think it's bad for the American people. We certainly see $5 trillion of tax increases, $7 trillion of spending, the highest rate of taxes on individuals in the last 40 years, and a new corporate tax rate higher than the tax rate imposed on Chinese Communist Party on their own businesses. More and more policies that undermine our own nation's energy independence and energy security. This isn't a budget that unifies the country. This budget only seeks to isolate and divide us. This budget simply said, taxes too much and spends too much. In the midst of all this budget talk, however, we are once again having to exercise important oversight over the federal regulators and agencies responsible for ensuring they're doing the job that Congress gave them the tools to do. As such, I want to spend some time discussing Silicon Valley Bank. While there are many questions that must be answered, I do know a few things for sure. First, the bank failed because of its management and because of its board. I know that the failure of SVB also was contributed to by a lax regulatory environment. I believe that the state and federal regulators failed to appropriately use the tools they have to supervise and regulate the failed institutions. And finally, that the Biden's handling of the economy contributed to these bank failures. The president's budget is further evidence of reckless tax and spending that will only exacerbate the highest inflation we've seen in 40 years. This impact will be felt by everyone and everything from grocery bills to financial institutions. It appears that the San Francisco Fed was asleep at the wheel. They failed to meet their basic, not enhanced, but basic supervisory responsibilities and therefore missed their opportunity to use enhanced supervisory tools if necessary. Instead of taking accountability for this blatant failure, regulators are now forecasting that they plan to increase regulations on the rest of the banking industry. In other words, the banks that made responsible business decisions and have not failed. The failure to supervise is inexcusable, and I plan to hold the regulators accountable. This administration's tax and spend reckless policies fueled inflation and will only further lead to unmanageable inflation and higher interest rates. Secretary Yellen, will this administration acknowledge that their reckless tax and spending contributed to not only the challenges that we see in everyday households, but also to the challenges that we're facing today with SVB?
Look, inflation is too high, and it is the president's top priority to bring it down. And there are many contributors to why inflation is too high. Importantly, fallout from the pandemic and Russia's war on Ukraine that boosted food and energy prices. Many countries around the world suffer from the same problem, regardless of what their fiscal policy was.
Thank you. I don't want to cut you off, but I only have a minute left, and I want to just, with my synopsis, there's no doubt that the pandemic was in the rearview mirror. We saw the COVID relief response in January of 21 that spent $1.9 trillion. The only thing missing in that COVID relief bill was COVID relief, which we had 1% for COVID vaccines, under 10% for COVID-related health, but we had a lot of liberal policies embedded in the $2 trillion of spending, which then led and accelerated inflation to a 9.1% or a 40-year high. The Fed response to the high level of inflation was to have 8 rate increases, leading to a liquidity challenge that we are now seeing the results of. Thank you very much.
Thank you. Senator Hassan.
Thank you, Ranking Member Crapo, and for holding this hearing today. Thank you to you and the chair. And Secretary Yellen, thank you so much for being here and for testifying before the committee. I would like to follow up on issues that my colleagues asked about concerning the recent actions that the administration has taken to protect our economy. Last weekend, the Treasury and other agencies took several steps to strengthen public confidence following the failure of 2 banks. The priority of federal regulators needs to continue to be protecting families and small businesses by ensuring the stability of our banking system and our economy more broadly. Given the events of the past week, I'd like to understand how Treasury is evaluating the effectiveness of its recent actions. So what specific benchmarks are you using to measure the success of Treasury's actions? For example, what are the economic indicators that you are actively monitoring?
Well, we are looking at indicators of the functioning and stress in the banking system. We want to make sure that the problems at these 2 banks don't spread to others, and so we're monitoring very carefully the situation of banks in the United States using a wide range of indicators. And a more general problem that concerns us is the possibility that if banks are under stress, they might be reluctant to lend where they're worried about shoring up liquidity and capital, and we could see credit become more expensive and less available. And there are a variety of statistics that we can look at to judge whether or not banks are tightening credit, things like the senior loan officers' survey of credit terms and related statistics on the cost of borrowing, because that could turn this into a source of significant downside economic risk.
Well, I appreciate that. I think being really clear about what the goals are and having transparency about defining success is critical here. And I just want to urge you and the administration to continue communicating with Congress as it closely monitors the situation to ensure that we have a coordinated and responsible and effective response to the entire situation. I want to turn now to tax issues that are overseen by Treasury. Last year, my bipartisan Home Energy Savings Act, something I introduced with Senator Collins, was signed into law. This bill expanded tax cuts for homeowners who make energy efficiency upgrades, such as installing a more efficient HVAC system in their homes, which also obviously lowers energy bills. How is the Treasury increasing awareness of these tax cuts for homeowners, given the high energy and other costs that families are facing?
Well, as you point out, there are really critical supports here for taxpayers. They can get up to $2,000 for upgrades like heat pumps, 30% on the cost of installing solar panels, and so forth. We have worked with IRS to publish plain language, frequently asked questions on all of these credits, and you can find this on the IRS's IRA homepage. There are also other sites, something called cleanenergy.gov, but really we want to get the word out broadly, and we would be eager to work with you to discuss ways that we make sure homeowners know what they're eligible for.
Well, I would look forward to continuing to work on that. Obviously, with high energy costs being what they are, especially in the Northeast, it's really, really important that we get the word out. Last question here. Along with Senator Brown, I'm leading the effort to cut red tape for online sellers by reducing the number of casual online sellers who receive unnecessary and confusing 1099 tax forms. It's important that we work across the aisle to find a bipartisan way to cut down on these unnecessary forms. As Congress considers various ways to address this challenge in a bipartisan way, will Treasury provide analysis of the impact of different proposals on online sellers?
Certainly we'll try to work with you on that. You know, we were trying to implement a provision of the rescue plan that required reporting of transactions over $600. Right. It's set to take effect this year, but we realized that there were concerns, broad concerns about that timeline, and so we've delayed, and we'll certainly, we want to reduce confusion, and we'll work with you to try to do that.
Well, I appreciate that very much, and I see that I'm over time. I will just note that there are a number of us in Congress who want to do more than delay it. We want to correct what we think is a bad policy and provides lots of confusion. So thank you very much. Thank you, Mr. Chair.
Thank my colleagues. Senator Young is next.
Welcome, Madam Secretary. It's good to have you here before the committee. I want to take a moment to begin to join my Republican colleagues in expressing my frustration and displeasure over the way the administration's handled the OECD Pillar 2 negotiations. To that end, Mr. Chairman, I ask unanimous consent that a copy of my longer statement on this topic.
Without objection, so ordered.
Thank you. So to summarize this statement, my concern is whether enacting the regime globally would undermine the incentive to invest in the United States and to grow jobs here in the United States. I fear the answer to that question is yes. In particular, the Pillar 2 undertaxed profits rule would uniquely disadvantage American workers and job-creating businesses by providing our trading partners with the political blessing to tax the U.S. activity of U.S. companies. That's right. Let me repeat that. Foreign countries under the undertaxed profits rule if these negotiations could tax the U.S. activity of U.S. companies, this would, of course, directly undercut our American sovereignty, but it would also impact the legislative power of tax writers to provide bipartisan, well-crafted, thoughtful economic incentives, like the research and development tax provisions important to our dynamic economy. This credit, which my bipartisan colleagues and I are fighting so hard to protect, and much more, look to be wiped out under Pillar 2. So, Madam Secretary, American workers and American companies deserve a better deal. And I want to begin by asking you to go back to the negotiating table and negotiating that deal for them. Moving on, Madam Secretary, as you know, President Biden has promised dozens of times that he won't raise taxes on anyone earning less than $400,000 a year. During the budget reconciliation exercise in August of last year, that was our second budget reconciliation, you'll recall, I introduced the not one penny in taxes raised amendment to allow the American people to hold members of Congress who agreed with that pledge and to hold the president accountable. That amendment passed the United States Senate by a vote of 98-1. 49 out of 50 of my Democratic colleagues agreed with Republicans. We can't raise taxes when Americans are struggling. Mr. Chairman, I ask unanimous consent that a copy of my amendment and the roll call votes be entered into the record.
Without objection, so ordered.
Secretary Yellen, in the view of the administration, which tax rates or other provisions from the Tax Cuts and Jobs Act that are scheduled to sunset after 2025 must be extended in order not to violate President Biden's pledge that no taxes will be increased on anyone earning less than $400,000. For the benefit of all members, in understanding these important red lines for the President of the United States, please include all provisions that you understand would cause the President's pledge to be violated if they are not extended.
Well, there certainly are aspects of TCJA that, if they sunset, would impact households or taxpayers earning under $400,000. And the president has, as you mentioned, pledged he doesn't want to see taxes raised by a penny on anyone making under that.
That's right.
So he stands ready to work with Congress.
Well, no, the president made the pledge, and so I want to know the administration's position on this. I know my Democratic colleagues will want to know it as well. My time is short, so can you please provide the specific TCJA provisions that have to be extended in order to keep President Biden's tax promise?
I don't know that I can provide you with that. I think there are a lot of complicated provisions, and exactly what happens to different taxpayers
That is reasonable.
will depend on
You're a reasonable
menu.
person. I'm known as a reasonable person, one right now that's 2 seconds over time. So I just ask you, Madam Secretary, could you commit to providing me and other members of this committee with that comprehensive list within 2 weeks from today? It shouldn't be difficult. You have an army of people supporting you.
I think it is a very complex exercise, and I'm not sure that
Is it
that
complex to keep the pledge?
The time of the gentleman's expired. I want to work with the gentleman with respect to the updates on the tax law. It's well known that on our side we opposed it, and your side you did. The gentleman wants to know how we're going to proceed, and the Secretary said it's complicated, and I'm going to work with my colleague.
Well, let's work our way through the complications so we can all keep our pledges. This cannot be violated. I've told my constituents it will not be. So.
And we agree with that and would like to work with
All right.
you.
I'll look forward to that list. Thank you.
Senator Daines is next.
Mr. Chairman, thank you. Secretary Yellen, thanks for being here today.
Thank you.
Secretary Yellen, the president's budget included $4.7 trillion with a T in total tax hikes, including $1.8 trillion in new taxes on Main Street businesses. The president's budget also includes a shadow tax increase on small businesses in Montana and across the country by remaining absolutely silent on the future of the 20% pass-through business tax deduction. We must remind ourselves that 95% of the businesses in the United States of America are pass-throughs. They're not C-Corps. And yet this budget was silent on a 20% tax increase coming for many small businesses in the course of 2026. I'm planning to reintroduce my Main Street Tax Certainty Act in the coming weeks, which would protect these businesses from this shadow tax hike by making this important deduction permanent. With the president's pledge in mind, will you commit to making the 199A deduction permanent?
I mean, all I can really say is that the president has pledged not to raise taxes on individuals or small businesses making under $400,000, but no promises with respect beyond that.
Okay, I'll take that as a no and move on to my next question. Senator Young raised this issue of Pillar 2 of the OECD proposal, which you spearheaded and have championed. It's littered with these complex rules that would benefit state-owned enterprises at the expense of capitalist competitors. Why are you a proponent for a framework that would allow China to tax American companies? And I understand this. I was involved in global operations for most of my 20-year career in the private sector. Tax companies on their American operations if they fall below the minimum tax threshold, even if they fall below the threshold by utilizing the bipartisan tax incentives such as the R&D tax credit.
So the agreement does permit, it includes an under-tax payments rule by which other countries can exercise their rights to impose taxes on operations of foreign countries.
Which would include China.
That don't abide by the 15% tax. The United States can impose a top-up tax to ensure that those revenues end up in the U.S. Treasury instead of in a foreign country.
I'll move on to child tax credits. As you know, Secretary Yellen, the 2017 Tax Cuts and Jobs Act doubled the child tax credit from $1,000 to $2,000 and increased refundability threshold to $1,400. I was certainly disappointed at the time that all of my colleagues on the other side of the aisle opposed this change and made it impossible to make it permanent, but I am glad that we enacted it as Republicans into law. The president's budget proposes increasing the child tax credit from the current $2,000 to $3,600. It makes it fully refundable and delivered on a monthly basis. However, I see they didn't make that change permanent. It expires in 25, even though there's no limitations in a presidential budget to do so. My question be this: does the president believe that the child tax credit should be made permanent for $3,600? And if so, are you willing to then eliminate the SALT deduction, which overwhelmingly benefits the wealthy, to give working families an expanded child tax credit that importantly never ends?
So the president is very supportive of the child tax credit, proposes to continue it for several years until many of the provisions in the individual income tax from TCJA expire that affect exemptions in the child tax credit, and then there'll need to be consideration of what to do as those.
But won't make that provision permanent, is what you're saying. The budget says it's going to expire in 25.
That's because there needs to be a broader consideration.
Doesn't have to, though. You could put the child tax credit there and make that permanent. So we could debate the tax cuts.
He's very supportive of it, and we would look to work with you to make sure that it's
expired. Senator Cantwell is next.
Thank you, Mr. Chairman. Secretary Yellen, thank you so much for not just today, but over the weekend and the much attention you've given to this issue. It really does impact small businesses, and while the name of a bank might be Silicon Valley Bank, I guarantee you the innovation economy comes through Seattle, and probably many small businesses in my state were impacted by what transpired. And why we need to make sure that the banking system really does have mechanisms that help the startup economy and the innovation. In my mind, that's why we did CHIPS and Science, is to let a lot of innovation unfold, but people have to get financing. So Jesse Salk, the grandson of Jonas Salk, is a molecular biologist and clinical oncologist who started Twin Strand Biosciences in the state of Washington. He and his team at Twin Strand are developing cutting-edge gene sequencing techniques to help us fight cancer. And he told my office this week that, quote, it was a big deal to step outside my comfort zone and start a company to help get a new genomic technology to help treat cancer patients faster. The last thing I expected us to need to think about was if we could rely on a bank. So the potential impact of Jesse's company having to pause or even cease operations due to banking failure isn't just jobs or dollars lost, which are important considerations to our economy. It's actually lives lost, too. So I, again, appreciate what the Federal Reserve, the FDIC, and everyone who stepped in, but it never should have happened in the first place. So my questions really are about these small businesses. Again, I think people think of them, oh, they're going to be giant businesses, but at their start, they are small businesses. So, and I think Silicon Valley Bank was able to attract and help further this. So now where do we go? Where do we go? Are we going to push Jesse back towards a larger bank? I'm curious. One of the reasons why there was so much of a concentration is that there was a requirement by the bank that you have all of your holdings in that bank. And so I want to hear what you think about that. How do we ensure that these small businesses feel safe in putting their loans in? Are we just going to see, how do we, again, treat a startup economy and allow these funds to work cost effectively? And should we get rid of this requirement that they have to, a requirement by a bank that says that they have to have, to get these terms, they have to have all their funds in that bank?
So I'm not aware of the requirement that you mentioned, but certainly we want to make sure that depositors, whether they're individuals or households or small businesses, feel confident that the banks that they entrust their savings to or their working balances that they use to pay their workers, we want to make sure that they feel confident that these banks are safe and that they can do business with them. And that's an important reason why we stepped in with the FDIC and the Federal Reserve to intervene, because I do believe the banking system in the United States is sound and resilient, and we wanted to make sure that the problems at Silicon Valley Bank and Signature Bank didn't undermine confidence in the soundness of banks around the country. And we wanted to make sure that there wasn't contagion that could affect other banks and their depositors.
Yep, so it's basically a requirement that it's an affirmative covenant that they maintain all borrowers' depositors.
That's something imposed by the bank, I assume.
Yes, on the startups as a way to corral. So I think this is why you had such a concentration, and we should look at that as a particular issue. What about Glass-Steagall? I've been a big supporter of Glass-Steagall. And when it comes to this moment, and I keep thinking, why did we ever allow us to have the commingling of separation of commercial and investment banking? It seems to me that continuing to protect depositors and having a system where people can take risk, and if they suffer loss, okay, but that's not what we have. We have such a commingled system now. What do you think about relooking at Glass-Steagall? Now, I'm not asking for the Treasury Secretary to make big news here. I'm really just asking if you thought this same situation would have occurred the way it occurred if we had not in 2000 gotten rid of Glass-Steagall.
You know, we're very focused right now on stabilizing the banking system and shoring up confidence. And I think there will be plenty of time. It will be appropriate to look at what happened and consider whether or not regulatory or supervisory changes are necessary, and look forward to working with you and discussing what happened and what response is appropriate. But for now, I would like to see confidence restored in the soundness of American banks.
Well, I would just say this on this subject. I believe in the information age, and I believe one of America's secrets is access to capital. So I want great access to capital formation. I don't want to see these banking that understands startups go away. I don't want it to be concentrated at big banks. But I also want us to make sure that we have a system that is I think we see now from 2009 what happened, and now this incident, that the commingling of these things are giving people, I'm not sure that's the way we get access to capital. I'm not sure that that's, or at least we didn't have a system that protected us. It didn't protect us in the end. So we have to get something.
These were depository institutions. They weren't investment banks.
Yes.
They were
yes.
Madam Secretary,
yes,
we've got to move on. I happen to share Senator Cantwell's views with respect to this matter. Next is Senator Whitehouse and Senator Casey.
Thank you, Secretary Yellen. I think you are the most available of all the cabinet members to come to hearings, and I just want you to know that I appreciate it. You seem quite fearless about coming into the lion's den, and we're always grateful to have you. You spoke recently to the Climate Financial Risk Advisory Committee, and in your remarks, you pointed out that climate change will likely become a source of shocks to the financial system that would lead to declines. This would be precipitated by declines in asset values that could cascade through the financial system, which is a warning that Freddie Mac has also made with respect to coastal property values. You added that rising insured losses could cause insurers to pull back from high-risk areas with potentially devastating consequences for property values. We just had a hearing in my budget committee on wildfire risk causing that effect to insurance and property markets. And before that, coastal flooding and storm risk causing that effect in insurance and property markets. And then that the whole thing can spill over to other parts of our interconnected financial system. Again, part of what Freddie Mac warned about, that it would be worse than 2008. We also heard testimony that the coastal property value crash risk and the wildfire property risk could perfectly well happen at the same time. It's not a question of one or the other. They could both come to pass. So we all know that shocks and panics and collapses and disorderly transitions are notoriously hard to predict as to exactly when they will occur. They're far easier to predict as to what their level of severity will be should they occur. And my question to you, setting aside timing, how serious to the U.S. economy could the economic shocks that you warned of in that speech be?
So I don't know how to quantify that for you, but I do believe these are very serious risks. The Financial Stability Oversight Council is prioritizing, analyzing those risks, and has recognized that they pose a systemic threat to American financial stability. The regulators, the banking regulators, FHFA, are all taking steps to analyze the way in which these risks could affect the financial system, financial institutions, and we created the committee that you referred to in order to bring expertise into this enterprise, but I think it's critically important, and these are
potentially deadly serious
risks, very severe risks.
And just for people who are not familiar with this particular arena, the word systemic risk sounds like a rather mild and inoffensive term, but it actually refers to pretty devastating stuff, does it
Yes,
not?
that is what systemic refers to, exactly. Things that could cascade throughout the financial system and have severe consequences for financial stability and the economy.
Thank you. In the time that I have left, I wanted to flag for you a letter that I will put into the record now, if I may, Mr. Chairman.
Objections ordered.
That a great number of us on this committee signed to the acting director of FinCEN. The chairman was a signatory of it. Senator Grassley was a signatory of it. Senator Warren was a signatory of it. And we are concerned that the development of the beneficial ownership rule has been far less than we had hoped and far less than we believed the actual statutory language directed, both regarding the so-called access rule, which is the subject of the letter, and regarding the verification standard, and regarding the court order requirement. If you would be good enough to take this back to your team and make sure that you have a look at this and make sure that you approve of where they are going, because I believe they have missed a very significant opportunity to significantly strengthen our battle against kleptocracy with the rather weak way in which these three parts of the rule have been rolled out. Thank you very much.
Thank you.
That's for under advisement.
Thank you. I take it that way.
Senator Casey.
Thank you, Mr. Chairman. Secretary Yellen, you have been very patient. I'm the last questioner, and I'll try to keep within my time in light of your appearance here. We're grateful for your time here. We're grateful for your service to the country. I did want to start just preliminarily by noting in earlier questioning about the phone call return rate at the IRS, there have been statements made today that went, some of which went unchallenged. And am I right to say that last year the phone call return rate at the IRS was about a low number, like 13%?
Correct.
And the current number is between 80 and 90%.
That is correct.
That is important for the public record, because I know that there's a narrative that the other side falsely is perpetuating. So 80 to 90% is a hell of a lot better than 13. You don't have to comment on that, but I'll just state that for the record.
It's huge improvement.
And that's...
And, you know, the IRS has been tremendously under-resourced, and the resources that Congress provided through the IRA are critically important. They hired 5,000 customer service representatives, have made enormous progress in working through the paper backlog, and are now, we're going to see continued improvements and, you know, great improvements in customer service.
Thanks so much for that. I want to talk to you first about, more broadly, energy communities, in particular coal communities. I live in Scranton, Pennsylvania, born and raised there, still live there, and happens to be the hometown of the president. But we live in a region that has basically 5 counties that were so-called anthracite, hard coal counties, historically. And then in southwestern Pennsylvania, you have a much larger number of counties that were so-called bituminous or soft coal counties. I don't have to tell you, most Americans know the story of what happened to that industry. We're told, though, most recently, that the Appalachian Regional Commission reports that coal employment has fallen by some 62% over the last decade, leading to broader decline in the region. And that's true in these communities in Pennsylvania. The report also indicates that overall private sector employment in Appalachian coal counties, that would of course go to West Virginia and several other states, has been flat since the Great Recession, but it was increasing in the non-coal communities. In the IRA, the Inflation Reduction Act, I fought for an additional tax credit of 10% that would encourage private companies to build new energy and manufacturing projects in these energy communities. To date, the Treasury Department has not released guidance on how companies can claim these credits, or guidance on what exact areas qualify. So without that guidance, companies have been reluctant to announce new projects in these coal or energy communities, and we've seen new investment flowing to non-energy communities. So I'd ask you to tell us, if you can, when can Pennsylvania and other states that have these coal communities expect Treasury to finalize the rules, the guidance, so these coal country communities can get their share of new jobs and investment?
This is a tremendously important provision. We recognize how hard hit these communities are and how important this bonus is. I can tell you that my staff is working utterly around the clock to write and implement these regulations. They're tremendously complex, and we will do this. It's a priority item. We will do this as quickly as we possibly can. I typically have several meetings a week with tax policy to make sure that things are moving as rapidly as we can make humanly possible, and this is a priority item for us.
Thank you, Secretary. I appreciate that. And the next question, I think I'll submit for the record, just want to preview it for you. We have this bizarre circumstance in the tax code where corporations are given a tax break for activities that are often union-busting activities, so they get a tax break for that. And at the same time, in the 2017 tax bill passed here in the Senate, a provision for union dues deduction and work expense deductions were taken away from individuals. So the worker got a tax break taken away, and big corporations have had this benefit to allow them to union bust and get a break for it. I have a no tax breaks for union busting act with 30 of our colleagues that I'm trying to pass, and I'll ask you a specific question about that. But in the interest of time, I'll submit that for the record. Thanks very much.
Thank you, Senator.
Madam Secretary, I very much share Senator Casey's views. I'm on his legislation for no tax breaks for union busting. And I think you all had that dialogue about the energy communities provision. Madam Secretary, I think we call it a priority. I'd like to designate it a super priority because Senator Casey led the effort for those energy communities in the effort on the IRA. And I know it's extraordinarily important to a host of these communities where there's a history of one energy policy, and we've got to get them the help Senator Casey's measure envisioned. So I thank him for it. Madam Secretary, we're going to let you leave in the kind of 2 minutes that I think we may have remaining, so we keep you on the clock. As usual, you have accounted for yourself very well today.
Thank you,
and
Chair.
I especially appreciate your saying, for what I believe is the first time, that prioritization of debt ceiling payments is just unworkable. That is the message that needs to go out far and wide. This committee, and let the record show, the Secretary has again said that's correct. This committee has jurisdiction over these issues relating to full faith and credit of the United States. So I very much appreciate what you're saying to us, your comments about clean energy, your comments about housing. You had the waterfront in front of you to talk about, and I just want to make one point in wrapping up. Republicans, in their tax amendments, these various tax amendments, define taxable income so as to give many billionaires a free pass on taxes. And that is really what the difference is. We feel very strongly about protecting all those firefighters and nurses and all the small business people. We all share that view. We are just unwilling, as are you and the president, to your credit, to give billionaires a free pass. And it is all about how these amendments define taxable income, which would basically keep billionaires from getting audited or paying little, if any, taxes for years on end. So we look forward to working with you in the days ahead. For the information members, questions for the record for the Secretary are due at 5 p.m. next Thursday, March 23rd, and the Finance Committee. And we thank you again. Secretary Yellen is adjourned.
Thank you, Chair Wyden.
Everyone's going to have to